Steve. Let's bring in Anne Walsh now, who's CIO at Guggenheim Partners Investment Management. $310 billion in assets, mostly in fixed income. Anne, thank you very much indeed for joining us this morning. Let's start there in fixed income and short term. How are you positioning ahead of PCE this week?
Well, we are looking at the economy as one that's perhaps at a very important inflection point. The Fed has continued to engage in quantitative tightening, mainly through the action of the reduction of the balance sheet. And while they are on pause, and we believe that they are intending to, and our expectation is that they will begin to cut rates here this year. And right now, I think that's going to happen more likely in May. And we're going to see the results of inflation coming down. But we always say markets don't move in straight lines. These data aren't moving in straight lines because there's a large economy that's happening. And as a result, we would anticipate that there are moments like the print in the CPI that we just saw, where you're going to see some conflicting data and information. Our expectation is that core PCE will continue its trajectory down. And so as a result, we're expecting rates to fall and to fall from that as a result.
That said, Chair Powell has not arguably taken a rate hike off the table still, though the dot plot seems to have done. Is there a non-negligible risk we could still get one more hike?
It's not really in our base case. And while I've certainly heard that potential, and markets sometimes, as I said, don't move in straight lines, that's certainly not our expectation. Frankly, there's really kind of two stories happening in the marketplace right now. Markets are quite bifurcated. The interest-sensitive reacting markets have been in some type of a slowdown or even a recession over the last, we'll call it 12 to 18 months. We saw leading economic indicators peak almost 2 years ago. Durable goods and other interest-sensitive parts of the economy have slowed down. We've certainly seen earnings at banks modest and frankly declining. And so as a result, what we're seeing is parts of the economy are not in great shape. And yet, and we refer to that as a bit of a rolling recession, and yet the market has continued to perform very well. And we keep pushing off expectations of Fed rate cuts. However, our belief is that we are on pause, that the rates are not going to go back up. And as I mentioned, the quantitative tightening is still happening in the background. And that has a powerful impact in the interest-sensitive areas of the economy. One area that we're particularly thoughtful about and cautious about right now in our rolling recession or cycle type of paradigm that we find ourselves in is commercial real estate in the U.S., in particular office, and the impact that it's going to have in small and mid-sized banks, and also their ability to lend into the small and mid-sized borrower economy or part of the economy in the U.S. I think this will all lend itself to the Fed continuing its view on pause and then ultimately on rates declining.
So, Anne, this is Martin here. They're going to wrap up QT by middle of the year, you reckon. What about the government debt? What about record issuance, though? I mean, that's going to continue putting pressure on yields higher, is it not? And that's going to be going against what the Fed wants to do?
Absolutely. You know, as the investment professionals, we tend to focus on the Fed only, and we tend to ignore, and maybe to our peril, fiscal activity. And the fiscal activity has been very stimulative, and the Fed's had to fight against it. Fiscal spending impulses have been very strong, and they will continue. And in fact, if anything, in 2024, one of the risks that we see is continued fiscal spending, deficit spending, causing the Fed to continue to have to fight against that, if you will. And these impulses then could actually extend out that period of time where the Fed will begin to actually start to lower rates significantly. When they do start to lower rates, and we do anticipate those cuts later this year, we would normally expect the long end of the yield curve to continue to come down. We've been in a trading range on the 10-year Treasury, and we expect that will continue. And that's probably going to range between 3.75 and 4.25. We can go a little higher than 4.25, depending on some of the inflation prints. Again, markets don't move in straight lines. And so as a result, what we would anticipate is we would expect the long end of the curve to come down. However, because of this fiscal spending and because of the need to continue to issue treasuries, that's going to put a floor under the long end of the curve quite significantly. We would not anticipate the 10-year being able to go down below 3.5%, even in a rate cutting environment.
So the curve is not going to disinvert, is what you're saying?
Well, it will ultimately uninvert. But for the time being, the fact that we continue to have an inverted yield curve is actually putting further pressure on interest-sensitive sectors of the marketplace. And as a result, again, it is actually creating a tightening condition, and real rates are much higher than I think that most market participants anticipate or expect. And I think that's putting pressure right now on, again, those interest-sensitive parts of the marketplace.
Understood. Okay, Ann, listen, stay right there. A little more to talk to you about. We'll continue with Ann Walsh, Guggenheim, when we come right back in 2. We're back live with Ann Walsh, Guggenheim Partners Investment Management. Still with us live up in Tokyo, where she's on the road. And we left off here talking about the risk that you and a lot of other people see in commercial real estate in the U.S. Let me ask you bluntly, are you expecting another medium-sized or regional bank to go bust? One, and how do you feel about AT1s?
So we would anticipate that there's going to continue to be pressure in the small and mid-sized banks in the U.S. We think that the Fed is going to have to engineer more mergers. Frankly, there's 4,400 banks and branches in the U.S., and the Fed has long felt that that's too many. And the one area of real worry as we see going forward in terms of our rolling recession theme is the area of commercial real estate, particularly office. It's the one part of the marketplace where there's still a wall of refinancing to occur in 2024 and 2025. And most of that refinancing will be occurring within the small and mid-sized bank part of the economy. The problem is that as those properties become repriced, those lenders will find more pressure in their capital as they face more and more potential defaults or delinquencies in that particular part of their lending book, limiting their ability then to lend further to particularly those parts of the economy that are dependent upon the banking sector. Again, small and mid-sized businesses especially. And so as a result, we do anticipate continued risk within that sector and likely another series of potentially banks that will experience the kinds of problems that we've already seen, and again more recently with, for example, New York Community Bank.
All right. So what I seem to be hearing, and weigh in, correct me if I'm wrong, is CMBS, commercial mortgage-backed securities. You probably like those. But back to the original question, though, what about AT1s?
Well, I'll address the CMBS in just a moment, but AT1s are an area that we've avoided. Just because at this point in time, we're generally avoiding the small and mid-sized bank space, and the structures of those particular transactions are not of appeal to us, given the downside risk. We certainly avoided the Credit Suisse AT1s, and we've continued to avoid that space. It is important to caution on CMBS. While we do not believe that the AAA tranches of CMBS or the higher rated tranches will ultimately, as an asset class, take losses, there is risk to the BBB tranches. What we saw in 2023 was that approximately a third of CMBS went into special servicing, a third at maturity paid off, and a third extended and were amended, and that is in the office space portion of the CMBS transactions. And so as a result, there are continued risks, again, particularly in office within CMBS.
And thank you for that. We will get back to you later on the program. We will talk about the emerging markets and opportunities in the regional bond markets. Ann Walsh there from Guggenheim.
And we're back with Ann Walsh, who joins us live up in Tokyo, Guggenheim Partners Investment Management. Get to Japan, what's going on there in just a little bit, Ann. I'm curious, China, though. You know, I don't know if it'd be fair to say they're kitchen sinking everything, but they've certainly tried almost every which way to get their economy going again. Most of the initiatives have been supply side, and we know that really doesn't address the issue, the core problem, which is on the demand side. What do you reckon?
So I think we have to look at China as well as the global market sort of collectively, and let's take the picture out a little bit broader and say global central banks outside of China have been tightening for the last, now we'll call it 2 years, and as a result, they've really taken a huge amount of liquidity out of the system, about $5 trillion worth in U.S. dollar equivalents. China being the exception, of course, their slowdown post-COVID and the lack of recovery in that time frame. They have a very significant challenge to try and bring back consumer confidence. It's not really the way that they are really thinking about trying to stimulate their economy, but they are working towards trying to regain export dominance in order to try and revive their economy amidst the pressures of the property valuation declines and so many other challenges that they have at this point in time. When I talk about the global environment with regard to the slowing and the impact of the central banks is the slowing of the economies globally. And that's really putting a further amount of pressure on China, as it has been putting pressure on European economies, Canada, and other developed markets globally, which makes China's job even harder because there's simply not the demand for their goods. And then, of course, there's the geopolitical impact of the U.S. and China relations and the whole movement on reshoring and friendshoring on manufacturing, again, making China's job even harder. Approximately 30% of global GDP over the last 10 years has been contributed by China, and that simply isn't the story going forward.
And what about Japan? And a question that we always ask investors is, when do you put on the long yen short JGP trade, which of course is a function of when the BOJ is going to exit?
So I think the Bank of Japan will likely move the final 10 basis points here sometime in the spring. But I really think that the challenges continue from a demographics perspective and a long-term perspective. Inflation is coming down. I don't think the Bank of Japan has to move tremendously from here. But this does challenge the Bank of Japan, particularly relative to the U.S. dollar. And until the U.S. economy slows down further, we're going to continue to see that trade challenging, in particular for U.S. investors moving to for Japanese investors moving to U.S. investments. The hedging is expensive still. But I think it will be moving in the direction of Japanese investors. I think the Japanese economy, however, is looking very good, and it's been a good place to deploy from an equities perspective, and I expect that will continue as well.
And let's just round off the conversation by bringing it back to the US and this exceptionalism narrative. How could the presidential election change the narrative potentially, and how much of a volatility driver could that be?
Well, it's certainly been a volatility driver already. I think it will continue to do so as we go through the course of the year. And it's driving geopolitical stories across the globe as well. And so I would anticipate that this year will continue to be one of volatility in markets, which is one of the reasons that we've positioned our portfolios to be up in credit quality, investment grade, U.S. dollar investment grade dominated, and seeking those particular areas of the markets where we really feel that our investors get paid, and at around 5.5% on U.S. fixed income, investment grade corporates, and other investment grade transactions. That's really been a good place to be, and we think it will continue to be a good place, notwithstanding the current geopolitical backdrop.
And whether it's green finance or whether it's infrastructure, the thematic opportunities in the bond markets, especially out here, how compelling are they?
So I think that there's a lot of opportunity there. As I started out earlier saying, we have a bifurcated economy. The markets should continue to do well. We don't anticipate that defaults will be increasing materially. The credit cycle is good, as we've seen. So I really think that investors can be embracing the opportunity, particularly again in U.S. fixed income, in investment grade, and even high credit quality, high yield as we go through the course of the year.
And we're going to have to leave it there. Thank you very much indeed for joining us. We appreciate it. Anne Walsh there from Guggenheim Partners Investment Management.